So for the weekend, I'm having such a relaxing day. I go to Starbucks with my wife. I sit down. I'm enjoying a nice cup of coffee. I open up my phone, which I shouldn't have done. And what do I see? Mayhem. Rumor spreading. Rumor mill. We are talking about, oh my God, things are about to break in the economy. Nothing as good is going on right now. Credit Suisse. I see Deutsche Bank. I see 2008. I see Lehman Brothers. I see everything you don't want to see in the Twitter feed that basically, if it's true, it means things are very, very bad right now. And that's what I saw. And I finally calmed down a little bit, and I had to drive from, I live in the Philippines, in case you don't know that, but I live in the Philippines. I had to drive from out of the province into Manila, which is where I live. And so basically I drove, it was like an hour and a half. By the time I got there, things were like back on, I'm like, it's out of my head. I'm calm, I'm clear headed. I'm like, okay, now let's look and see what's going on. It just goes to show when you see things at first and you gotta freak out, you gotta like take a step back and think to yourself, wait, let's think about what's going on first and then make a decision about what we think is going on. And so here's what I think is going on. And here are my thoughts on everything that just happened about Credit Suisse potentially blowing up, being a new Lehman Brothers, a new 2008 recession type thing. And this is what I have to say. So I'm sitting at Starbucks. I'm like looking at my phone, and this is what pops up, basically. This is what starts this whole thing. So this thing got a lot of traction. A lot of people saw it, and people were talking about this and some other tweets that were out there. I don't know if this is what started it, but this was definitely in the mix of big tweets that were going on over the weekend. And basically, it says Credit Suisse's CDS spreads at 14-year highs. So CDS is a credit default swap, which we're going to talk about in a second. But basically, it's showing that the spread essentially here is 250 basis points, almost, let's say 300 basis points. And it's getting close to the 2008 level, right? This 2008, and this is where we are today. And look how fast it shot up. And it's scary because we all know what happened in the financial crisis back in 2008, Lehman Brothers, and we're looking now and saying, is this a Lehman Brothers moment? That's what was kind of getting the traction on Twitter over the weekend. And it says 600 billion, what Lehman Brothers held in assets when they crashed and took the economy with them. 2,800 billion, which people please don't write 2,800 billion, write 2.8 trillion. And I think it's even less characters. I mean, come on. But 2.8 trillion, what Credit Suisse and Deutsche Bank control in AUM, assets under management, 4.6 times more. And it says Credit Suisse is at a critical moment now, says the CEO, what lies in store for the world, unroll, and he goes through a little thread. Now, here's the thing. I didn't even realize this when I read this. I was skimming it over, and I was just kind of like so in shock about what I thought might be happening, and so like kind of like getting frantic about it, that I didn't really read this tweet. And then I thought about it later after I opened up Twitter again, after I did that drive to Manila. And this is basically exactly what is the deal with that tweet, because it's kind of misleading. And you know what's wrong with that tweet? It's kind of like I don't like tomatoes, but like all the time people are asking me like, oh, but you don't like pizza? And I'm like, if you think a raw tomato tastes like a Little Caesars pizza, you need to get GTFO. I mean, that doesn't make any sense. A Little Caesars pizza, that's a bad example of a type of pizza. But you know what I'm saying? A pizza does not taste like a raw tomato. I don't like raw tomatoes, but I like pizzas, okay? What he's doing is he's kind of convoluting two different things here. And this is, Saira here has a good point. 144,000 followers and tweeting like this is meant to make sense. And so basically she's dragging Graham Stephan, which, I don't like, I want to drag the guy because I like the guy. But, it doesn't make sense what he wrote in this part of the tweet. So what is AUM, Graham? Show me where it sits on the balance sheet. And basically what she's saying is he puts here 600 billion is what Lehman Brothers had in assets, and then 2.8 trillion is what Credit Suisse and Deutsche Bank together control in assets under management. Two completely different things that shouldn't even be in the same tweet. That are very misleading. And so let's think about this. Okay. Well, if you are Lehman Brothers and you have assets, well, let's say I own Lehman Brothers and I own a $100 million building in New York City, right? Well, that's an asset. I can get rid of it. I can sell it, hopefully, right? And I can get cash for it. And that's actually an asset, right? It is a real hard physical thing that we own as this bank. AUM, I go to buy an index fund with Charles Schwab, right? Any index fund that's a Schwab index fund, and they hold my assets, right? They have assets under management. My assets are there. But what happens if Schwab goes out of business? What happens if there's a bankruptcy problem, right? Do they get to hold my assets? No, they don't. They don't get to go sell off my assets and pay off debtors, right? They do with their real estate, but they don't with the money that's my money that's invested with them. So it makes absolutely no sense. So comparing this is honestly, it's like when people tell me that, like ask me, why do I like pizza if I don't like raw tomatoes? I mean, people, come on. A little sensitive about this subject because it happens all the time. So anyway, let's talk about what a CDS is, credit default swap. It's a derivative product which serves as a form of insurance against the default of an underlying borrower or debt instrument. This is from Wikipedia. Okay, that's a lot to unravel, but basically let's say the spread of a CDS is the annual amount the protection buyer must pay the protection seller over the length of the contract expressed as a percentage of the notional amount. Think of it like an insurance premium, right? You're paying a premium and the spread is, let's say, the premium that you're paying to basically to get insurance and protection on a bond. Let's say I go and I buy a bond from a government that's having problems, right? It's a sovereign bond and this government it's in shambles and I'm getting lots of maybe interest, but I'm scared of the risk. I can pay insurance on this bond, and so someone else may take the default risk. So if the bond defaults, maybe I get this insurance money in from this other insurance carrier place that is going to insure this bond for me, right? So that's a credit default swap. And so back to the credit default swap and why people are kind of like getting scared about what was going on about this over the weekend is that this is the 1 year tenor for the credit default swap, which was not the one that Graham Stephan showed. He showed, I believe, the 5 year, but this is from Randy Woodward, and I'll get to this in a sec, but he says, you sure at C. Gasparino, and then this is the spike, as you can see, giant spike in the in the spread of the credit default swap, the 5 year credit default swap for Credit Suisse, going from like under 150 basis points, which is 1.5%, all the way up to over 5%. Back here is the Great Financial Crisis. Obviously, we are a lot higher here, and this looks very, very scary. And it's starting to, spread across Twitter, and these things are going on. And then we have Charles Gasparino here, and he's a journalist for Fox Business, and he's saying, breaking Wall Street execs who met recently with Credit Suisse CEO Ulrich Korner. Ulrich, I think it's Ulrich Korner, say they were assured the bank's issues involving are confined to its troubled iBank investment bank, and the entire firm has adequate liquidity or capital. Then again, that's what Dick Fuld said. And then we're talking, this is referencing, of course, Lehman Brothers, right? So Lehman Brothers comes out in 2008 and they're like, we're good, we're liquid, we don't have any problems. 2 weeks later, the bank is crumbling and it's over, right? And so this is why it's like a Lehman moment, as they say. So how do I put this? It needs a huge makeover. I mean, people need to go in there. It needs to change its culture. That's not a good bank. It does not have a good track record right now. It has its own scandals that have happened, and this is one that we're talking about here. Credit Suisse settles U.S. shareholder lawsuit over risk exposure from Archegos. If you don't remember what that is, this is last year. I think second quarter last year. Archegos basically blows up, and Credit Suisse is one of the main institutions involved with Archegos' blow up. And it says here, and regulatory scrutiny for the bank, which became saddled with its unacceptable $5.5 billion in losses from Archegos Capital Management, founded by Bill Huang, to manage its asset collapse. And so what happened was this guy, Bill Huang from Archegos, he goes out and he has this, let's say, exotic derivative type thing that he uses, and he's trying to he's taking loans from banks, from institutions, which, by the way, they're giving it to him, so they're at fault. It's their fault that they're not doing their due diligence, their risk measures that they should have done. And so this says Bill Huang had $20 billion, then lost it all in 2 days, the fastest rise and even faster fall of a trader who bet big with borrowed money. Borrowed money being part of it from this company, from Credit Suisse. He also borrowed from Nomura of Japan, I think UBS. And so what went wrong with Archegos? The bespoke derivative contracts Huang used at Archegos Capital to enhance his market positions were at the epicenter of the financial crisis of 2008 and 9, and yet Huang's primary brokers such as Nomura, Credit Suisse, Goldman saw no harm in extending such margins to an individual charged with fraud. The guy has had a checkered past. He's still getting loans. Apparently risk management is not being done, and he just blows up his portfolio and essentially other investment banks as along with it. Now, okay, let's go back and say what's up with the credit default swap. So we basically have, what I'm trying to show here is that Credit Suisse has had its own problems, right? Credit Suisse is not necessarily a great track record of an investment bank. And so maybe their wealth management arm is okay, but their investment bank is no bueno, okay? So this here is from Corey Hofstein. It's showing us the term structures and things like that of the actual credit default swap. Basically, the deal is it's not a huge rate of potential default risk. Let's say, per year, it looks like the default risk in year 1 is 2.48%, then 3, then 4, then 5, then almost 6%. So we're not talking about huge default risk here, but of course it's gone up a lot, and that's maybe a sign that is spooking people that the rise up in that spread is what has been scary. Another thing that's all over Twitter is the stock price of Credit Suisse just tanking, and that's something that was scaring a lot of people. And they're basically like, this company's going out of business. Like, this stock is down so much, probably going to go out of business. Here's the return of the stock from about 2006, right? So obviously down 86%. That's not a good investment, right? I don't think anyone would agree that this is something that over this time period has looked good at all, right? It's been in a complete downtrend this entire time since 2006. So, well, not 2006, since 2008 when it peaked. And let's see how far down this thing is. If we go back to 2008 peak, so from peak to trough, it's down 92%. So, not too bad. And then let's compare this to some other banks. So we have Deutsche Bank, okay? Deutsche Bank equally looking absolutely terrible, awful, and no one likes how this thing looks. But we have Barclays. Now, interestingly, no one's talking about Barclays, but Barclays doesn't look great. It looks better. Doesn't look great, down 54% as opposed to 86% going back into this time period. Let's take a look at some other ones. We got UBS. UBS also not looking so good, kind of more similar to Barclays. So these are all not great ETF. These are all not great bank companies, right? These institutions aren't the best when it comes to their stock prices. But of course, these two, they look just awful, really awful. Let's take a look at this year to date. So year to date, we could see that Credit Suisse is now really just tanked, down 58% over a 1 year period. Deutsche Bank down 37% over a year period. And then you got Barclays and you got UBS up here, not down too bad. But, if we take a look at something like a Citibank in the U.S., because these are all European banks here, but Citibank ain't looking so good either, down 38%, right? You have to go to like one of these high tier banks like JP Morgan. Actually, JP Morgan down 33%, okay? Banks aren't looking so good. Obviously, Credit Suisse looking worse than other banks. But, at the same time, people are showing these charts of like, it looks so bad, but they're not really showing the charts of their peers. It looks worse when you look at just one bank. It doesn't look as bad when you're looking at all these banks combined. Now, I will give you some context to go to the 5 year, and obviously JP Morgan looks much better, right? This blue line in the top, it's up 27%. So one of these banks actually is doing pretty decent. And, obviously Credit Suisse down 72%. But for the year, these banks aren't doing so hot. Just wanted to make it a little more fair, give both sides of the argument here. But anyway, back to Alex Good. He's basically saying, he's saying that Credit Suisse's earnings per share has declined so much. Earnings estimates have declined so much, also with its stock price. So it's an earnings story of this bank, right? It's not necessarily anything more, and it's been declining for a long time. It's not necessarily like just overnight type thing, which I think some people are thinking is what's going on. It's like they're thinking, oh, Credit Suisse is a great bank. It's doing a very good job making lots of earnings, growing earnings. It's got a great stock price. Oh no, something suddenly came out of left field and the stock is tanking and the company's going out of business. That's not the story here. Last thing I have here is what Alex Good said, and basically I agree with this, and this is how I basically feel about this whole thing. He says, am I jumping up and down to fade the CS panic? No. Is it Lehman? No. That's how I feel too. Like, I could see this company completely just going out of business. And I mean, obviously, it's going to cost a lot of money for it to be lended money to, right? To raise capital for what it needs to do. And so, can the company go under? Yeah, it probably could at this point, and that's what he also says. Could the stock go to zero because of bond market liquidity issues compounding its asset sale plan? Yes, which is probably relevant to financial stability narrative. So, of course, yes, this company could end up going out of business. Will it reverberate throughout all of the markets of the world? Will it bleed into the United States, out from Europe into the United States? Will there be contagion? I don't think there will be, but I mean, what do I know? I'm just a guy on YouTube that just talks about stuff on what's going on the market. So I don't think I am not going to not invest my money because of what's going on here. Let's just say that. So that's all I have for this video. Whatever side you're on this thing, I mean, let me know in the comments. I'd love to hear from you. It's interesting. I don't know what's going to happen. I'm not sure. But I think it's a very interesting time to be investing and understanding what's going on right now. So thanks so much for watching. Hit that like button if you like this. Subscribe to see more videos like this. And I got another video coming up on the end screen right now. Thanks everyone so much for watching. I do want to remind you I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence.